Ever stop to think just how connected a policy decision made in Washington, D.C. is to, say, the price of diesel in Mumbai,
Yeah.
or even inflation targets over in Frankfurt?
It's incredibly direct now.
Yeah, it's not some slow historical trickle anymore. A single announcement can send ripples, immediate, measurable economic waves across the globe.
Exactly. It's that instant connection between, high-level geopolitics and the real financial decisions hitting consumers, hitting corporations everywhere. The sheer speed of it is what makes this so important to understand.
Absolutely. And that speed, that mechanism, that's what we're digging into today. Our mission for you, the listener, is really to unpack the immediate economic fallout from these brand new U.S. sanctions, the ones targeting major Russian oil companies. We want to see exactly how these specific actions translate into, well, everything from gas prices right up to those big central bank interest rate decisions.
And we've been looking at analysis detailing exactly that the rapid fallout from these latest U.S. restrictions. What we're seeing isn't just another sanction. It's almost like a case study in how policy actions can trigger really fast nonlinear market shifts.
Okay, let's unpack this then, starting right at the beginning, the trigger. So the action itself was pretty focused, wasn't it?
Yes, they're very targeted.
The U.S. announced new, stricter sanctions on two massive Russian oil players, Rosneft and Lukoil. And the key thing seems to be restricting U.S. entities, U.S. persons, from dealing with them or their subsidiaries.
Right. Essentially cutting them off from large parts of the Western financial system. That's the official action. But the real supply shock, the mechanism behind it, isn't just about who in the U.S. complies.
Right.
It's about this huge global chilling effect that these announcements create almost instantly.
Okay, tell us more about that chilling effect, because we are seeing major buyers, refiners, especially in places like Asia, other countries that aren't actually part of the sanctions. They're immediately hitting pause, or at least cutting back imports of Russian crude. So why would buyers in, say, India or China, who aren't officially sanctioning Russia, care so much about a U.S. rule?
Well, this is really the core insight from the sources. Their hesitation isn't really about, political alignment. It's pure logistics. It's risk management.
Okay.
Think about it. Oil tankers, right. Regardless of where they're going or who bought the oil, they overwhelmingly depend on Western services.
Services like?
Specifically, protection and indemnity insurance P&I clubs. These are mostly based in the U.S. and Europe, so if a non-Western company deals with one of these newly sanctioned Russian firms...
They risk losing their insurance.
Precisely. They risk losing access to this absolutely critical global insurance coverage. And without that, their whole fleet could be effectively stranded. It's a massive risk.
So it's the plummeting of global trade, the insurance, the finance that freezes things up, not just the flag on the ship. Even if a buyer wants the oil, the system makes it too risky, too difficult to move it safely and legally. So they just stop.
Exactly. They'd rather pause immediately than take that risk. And on top of that, there's the whole issue of dollar clearing.
Right.
Even complex deals that aren't directly in dollars often touch the U.S. financial system somewhere along the line. Buyers worry instantly that they could get locked out of dollar transactions. And that's, the lifeblood of trading commodities. So that immediate hesitation, that creates a very real, very sudden supply shock.
But hang on. Rosneft, Lukoil. These are huge companies. Russia's been dealing with various restrictions for years now. Was this market reaction, this immediate price spike, really justified? Or if it may be a bit of an overreaction driven by fear?
That's a fair question. And the analysis seems to suggest the reaction was largely warranted. Why? Because these specific sanctions appear to target the workarounds that had developed.
Oh, okay.
Russia is a massive producer, still supplying over 10% of global oil. So when even a small part of that supply suddenly becomes logistically tangled, not because the oil vanished, but because the global system can't afford the risk of moving it, well, the whole global supply picture tightens up fast.
And the market reaction certainly showed that. It was sharp. Brent crude futures, the big international benchmark, jumped, about 5.4%?
Yep. And U.S. WTI crude saw a very similar rise, around 5.6%, in a really short window.
But you also mentioned diesel, distillate futures. Those rose sharply, too. Why is that detail important?
That points to something maybe deeper, more systemic. The rise in diesel futures suggests refiners were anticipating better crack spreads.
Okay, explain crack spreads for us.
Sure. The crack spread is basically the profit margin a refiner makes. It's the difference between the cost of the crude oil they buy and the price of the refined products they sell, like gasoline, jet fuel, or diesel.
Got it.
So when those refined product futures rise even faster than the price of crude itself, it signals that global refining capacity is tight. It tells you the market expects not just expensive crude oil, but also expensive finished products. That means the supply shock is already moving right through the whole energy value chain.
Okay, so let's pivot from the trading screens, maybe to the kitchen table, metaphorically speaking. What's really fascinating here is how quickly that energy shock translates into these tangible, potentially quite lasting risks for the wider global economy, far beyond just energy companies.
Right, and this is where we crash right into the inflation problem. That sharp jump in crude prices isn't just a number on a chart. It's probably the biggest single inflationary risk we're looking at right now.
Because higher oil means immediate higher costs for fuel, for transport.
Immediately, yes.
Which means pretty much every physical good, right? From, I don't know, car parts shipped across the ocean to vegetables trucked across the country.
Yeah.
Energy costs are baked into all those prices.
Exactly. And when those input costs jump suddenly like this, it puts undeniable upward pressure on overall consumer prices. The things central banks track obsessively, like the CPI and PCE reports.
But this kind of inflation, you hear economists call it cost-push inflation, driven by supply problems. That's much harder for central banks to deal with, isn't it? Compared to, say, inflation from too much demand.
It's significantly harder. That's the policy headache right there. Central banks, like the Fed, their main tool is raising interest rates. And rate hikes are designed to cool down demand.
Right, to slow spending.
If inflation is mainly coming from a supply shortage, like sanctions suddenly making oil harder to get, raising rates doesn't magically create more oil barrels.
So why don't they just ignore it then, if their tool doesn't fix the root cause?
But they can't just ignore it. That's the bind they're in.
Why not? If raising rates to fight something they can't directly fix just ends up slowing the economy. Isn't that the second big risk here?
Yeah.
An economic slowdown.
That is the massive trade-off, the absolute dilemma for policymakers. They feel they have to act because of inflation expectations.
Okay.
If consumers and businesses see energy costs shooting up and they start expecting inflation to stay high, expecting higher prices tomorrow and the day after, those expectations can become self-fulfilling. People demand higher wages. Businesses raise prices preemptively.
It creates a spiral.
Exactly. So the central bank might be forced to hike rates, or at least keep rates high for longer, not really to fix the oil shortage itself, but to anchor those inflation expectations, to stop them spinning out of control. And that makes the path back to lower interest rates, which many parts of the economy need, much, much more difficult.
And all this is happening while the economy might already be slowing down naturally because of these higher costs. This goes back to the consumer, right? If your household is paying way more to fill up the car, or if a business is paying more to run its factory,
you have less money left over, less discretionary income for other things, services, going out, buying non-essential goods. It hits consumers hard.
So retail, leisure, those sectors feel the pinch.
Absolutely.
Yeah.
And at the same time, businesses are dealing with those higher input costs, higher transport costs. That squeezes their profit margins, often leads them to tighten their belts, maybe pause hiring, delay investments. All of that feeds the slowdown risk.
And then there's this other term we hear a lot, the geopolitical risk premium. It sounds a bit abstract. How does a specific sanction like this actually affect that risk premium that gets priced into assets globally?
Yeah, it sounds abstract, but it's very real for markets. The geopolitical risk premium is basically the extra return investors demand for holding assets that might be affected by unexpected political shocks or instability.
Okay.
So when sanctions escalate or when there's a credible threat of supply disruptions like now, that premium goes up. For someone trading bonds, it might mean they demand a higher yield on government debt from certain regions just to compensate for the increased volatility.
And for stocks?
For stock investors, it often means moving money out of potentially vulnerable sectors, maybe consumer discretionary, and into safer havens like utilities or essential goods. It just creates this general sense of caution, more volatility across the board, stocks, bonds, commodities, regardless of how any individual company is actually doing.
Okay, this is where it gets really interesting, especially for anyone watching the stock market. The sector shifts. Because this kind of supply shock, it's almost like a zero-sum game in the short run. There are clear winners and losers.
Yeah, the immediate winners are pretty obvious. Energy and commodity stocks.
Right.
Especially the upstream producers, the oil service companies. They benefit directly from higher prices for the stuff they sell. If the price of oil jumps 5%, their margins can improve pretty dramatically because of the way their business works, that operational leverage.
And the analysis we've looked at really highlights energy stocks as being, well, structurally attractive beneficiaries right now,
Yeah.
given this tighter supply picture. But who's on the losing end?
Well, it's the sectors that have to absorb those higher costs.
Okay.
Consumer discretionary stocks, like we talked about, face real headwinds because people just have less spare cash when fuel costs are high.
Makes sense.
And also think about airlines, logistics companies, heavy manufacturing. They all feel that immediate pain from soaring fuel and energy input costs.
Let's talk about the timeline then. There's this sort of near-term pain, but maybe some medium-term hope. It sounds like right now, in the immediate future, prices are just likely to stay high and bounce around a lot.
That's definitely the near-term consensus, yes. This is a significant supply shock. It pushes energy prices up simply because the market can't instantly find replacements for that affected Russian crude or figure out all the new logistical risks. So expect volatility until things become clearer.
But looking at it a bit further, maybe 3 to 6 months, there's this counter idea, right, that supply might adjust. Who are people counting on to step in?
Yes, that's the hope that's probably preventing prices from going even higher right now. The thinking is, over the medium term, if other big producers increase their output, the supply situation could theoretically ease.
And who are we talking about specifically?
We're mainly looking at two groups. First, OPEC, especially key players like Saudi Arabia and the UAE, who are generally seen as holding the most readily available spare capacity.
Okay.
And second, U.S. shale producers.
What are the holdups for those two groups? Because it's not like they can just flick a switch and flood the market overnight, can they?
No, definitely not. OPEC has its own complex internal politics, production quotas, and a strong interest in maintaining price stability, not necessarily crashing prices by oversupplying.
Right.
And for U.S. shale, the constraints are more financial and infrastructural. Many shale companies have shifted focus recently. They're prioritizing capital discipline, giving returns back to investors rather than just drilling aggressively, even if prices are high.
Even with high prices.
Even with high prices, the focus has shifted. Plus, actually ramping up production takes time. You need rigs, workers, pipeline capacity. None of that appears instantly. So if these constraints cause significant delays in that supply response, well, that medium-term outlook changes quite a bit.
Okay, this brings us to probably the most important part for you, the listener. If you're trying to make sense of all this, what are the key things, the clear indicators you should be tracking right now to see how this is playing out?
We've zeroed in on 4 key areas to watch. First, pretty obviously, keep tracking those crude oil futures, Brent and WTI. Are we seeing the initial spike hold, or does it start to fade? That could tell you if buyers are finding workarounds or alternative supplies faster than expected.
Okay, number 1, oil prices. What's second?
Second, and this is critical for the whole policy impact we discussed, keep a close eye on the upcoming inflation data, CPI, PCE reports. You need to see if this energy price jump stays just in energy or if it starts genuinely pushing up core inflation, feeding into those broader price expectations.
Right. Is it contained or spreading?
Third is the direct consequence of all this pressure. Watch central bank communications very closely. Listen to what the Federal Reserve, the ECB, and others are saying. Are they changing their forward guidance? Are they specifically mentioning this energy shock as a persistent problem? Has their thinking on potential rate cuts shifted because of this?
Their language will be key. And finally, the 4th indicator.
Finally, dig into energy company earnings reports and their guidance for the future, especially the U.S. shale producers. Are they actually reporting better margins because of higher prices? And crucially, are they guiding towards significantly higher production in the coming quarters because of these prices? That guidance is the real litmus test for whether that medium-term supply adjustment is actually happening.
Got it. Futures, inflation data, central bank talk, and energy company guidance.
Exactly. And if we sort of zoom out and connect all the dots, the big takeaway here is really the precision and the depth of this reaction. You have geopolitical sanctions hitting very specific points, the financing, the insurance for major firms like Rosneft and Lukoil. That creates a clear, undeniable, immediate supply shock. And that shock then translates almost instantly into inflationary pressure. And ultimately, that pressure dictates how central banks around the world have to react. It's a direct chain. Cause effect, policy response, high stakes.
It really is. It's maybe the clearest example you could find of how decisions made far away land right on your local gas station sign and then force central bankers into these really difficult, agonizing trade-offs.
It is. But here's maybe the final thought to leave with you, the listener, something provocative to chew on. The market's current view, the hope that keeps prices somewhat anchored, is that this will ease in the medium term.
Right, the expectation that someone else will pump more oil.
Exactly. It hinges entirely on the expectation that other producers, OPEC, U.S. shale, will actually manage to overcome their own constraints and step up production enough to rebalance the market.
So the massive question you should be asking yourself is, what if they don't? What if that extra production just isn't enough or gets seriously delayed because of that capital discipline or pipeline bottlenecks?
Because if that rebalancing act fails or takes much longer than expected,
Yeah.
then this supply shock isn't temporary, it's prolonged. And that would mean inflation stays structurally higher for much longer than policymakers currently anticipate.
Which changes everything.
It fundamentally changes the long-term outlook for global interest rates. It could force major central banks to keep rates much higher for much longer, potentially for years, just to prevent that inflationary spiral. That is the really critical risk scenario we all need to keep watching.
A really powerful point to end on. Keep tracking those indicators we discussed, the futures, inflation, central bank signals, company guidance. They'll tell us which way this crucial dynamic is heading. And until next time, keep digging.